on this computer. And then I got to unmute. Eddie, you're signed in as Eddie or Ed Stone? Which one are you? Ed, oh, he can't respond because he's muted, right?
You muted me.
Oh, okay.
I think I've signed up as Eddie. That's what it says on my screen.
Okay. And Julie, can you unmute yourself or do I have to do it for you?
Nope, I'm good. I can unmute myself.
Okay, very good. And Connie. All right. Great. All right, so we'll get started, okay? My name is John Phelps. I'm president of GE Retiree Benefit Solutions. Today is about pension plan de-risking. It's an information webinar. You'll see we're going to cover many facets of pension plan de-risking as we go along. It is being recorded and it will be available afterwards. All the materials in the video recording will probably be posted on our formal website. Okay, as far as questions, two things. There's a chat. If you look on the bottom of your screen, the toolbar, there's a chat function and there's a raise under reactions, a button that says reactions, an icon button that says raise your hand. Again, all are muted right now, but if you have questions, Julie, Ed's colleague, and Connie will collect those questions and they will present them to Ed. If it's a real, like if you really feel you need to have clarification at a certain point, Ed will decide whether he wants to take the question or not, okay? Otherwise, we want to hold the questions because Ed has a lot of material to cover. And so we'd hold the questions to the end and then either Connie or Julie will read them. Read your question, give your name and read your question to Ed, okay? And then Ed will answer it. And there is no dumb question, so ask away, you know, believe me. We've learned a lot since Ed did this presentation. I'm sure you're going to learn a lot. So welcome everybody, and we're glad you're here and that you joined us. Okay, so why are we concerned? If you're seeing that, I hope you're seeing the screen and you're seeing the agenda here. Why are we concerned? There's a number of pension plan de-risking strategies that GE has already implemented and the possibility of more coming. And this little graphic right here kind of gives you a generalized idea of what we're going to discuss today. What are those de-risking strategies? And that'll explain a lot of these. Pension freezes, buyouts, transfers, annuity transfers to an insurance company, lump sums. All those things are part of what the definition of pension plan de-risking, just so you know that. And that's why I like that graphic, because it's short and concise and explains it a little bit, gives you an idea. All right, so what's GE's motivation, the reasoning in making the pension plan changes? Well, these are quotes right from GE people. On the Winokur investor update on 3/29/21, Carolina, who's the CFO for GE, pointed out we have to have the flexibility to reduce debt and pension, and she gives a number there, an additional $25 billion. So again, remember the reasoning, that reduce debt liability, and part of that is pension de-risking strategies. Kevin Cox, who is the Chief Human Resources Officer at GE, said, returning GE to a position of strength has required us to make several difficult decisions, and today's decision to freeze the pension is no exception. We carefully weighed market trends and our strategic priority to improve our financial position. Again, it's about liability, debt, and improving their financial position, reducing that debt and liability. And then when they announced the Athene, where they transferred the 70,000, number 4, you'll see below, it'll be covered here, but it'll go into all of that in more detail. He said at that time, Kevin Cox said, GE continues to appreciate the thousands of retirees who delivered our customers, for our customers, our share owners, and for each other. As we seek to balance GE's ongoing obligations, financial obligations, with the need to strengthen our balance sheet, we are pleased to enter into this agreement with Athene, a highly rated company that will serve our group of retirees, the 70,000, under $360 a month. Again, you'll see down in 4. Ensuring that they will get the same benefit on the same schedule as what they receive today. And you'll hear Ed talk about later, Athene is just one of the players in this game of de-risking. You'll see there's other big players like Prudential, MetLife, also are in this game. And there's other companies. You'll see it on a slide that Ed presents later on. So what are the changes that GE has already made? GE pension plan recent changes. October 7, 2019, this is right off the GE site. Announced today it's taken 3 actions related to U.S. retiree benefits as part of its strategic priority to improve its financial position. Remember the terms up in the graphic. Freezing, number 1, freezing the U.S. pension plan for approximately 20,000 employees with salary benefits and U.S. supplementary pension benefits for approximately 700 employees. Number 2, pre-funding. Pre-funding is always a prerequisite, folks, to any kind of annuity transfers. Just remember that. Ed will explain. Approximately $4 to $5 billion in estimated minimum ERISA funding requirements for 2021 and 2022. Some of those came from asset sales like Biopharma and Baker Hughes. They transferred money over to bring it up to that minimum level, that ERISA minimum level. Number 3, offering a limited time lump sum payment option. There's the lump sum, so it's underlined again from the graphic. And again, all these different strategies or facets or of de-risking, Ed will explain later on. So offering a limited time lump sum payment option to 100,000 eligible former employees who have not started their monthly US GE pension plan payments. In total, these actions announced today are expected to reduce GE's pension deficit, again, another liability that weighs on their bottom line, by approximately 5 to 8 billion, and its industrial debt by approximately 4 to 6 billion. Okay, I think out of that 100,000, I think 45,000 chose to take the lump sum and the rest stayed with the annuity. I'm pretty sure on that. Number 4, December 15, 2020. This is a new date, in 2020. GE announced today that it transferred approximately 1.7 billion of its US GE pension plan obligations by purchasing group annuity contracts from wholly owned subsidiaries of Athene Holding Company, a leading retirement services company. I have to move this up because I got a little box in there that's blocking me. Approximately 70,000 of GE retirees and beneficiaries with benefits under $360 per month will receive their monthly pension benefit payments from one of Athene's wholly owned subsidiaries. Ed's going to explain this whole structure of Athene, either Athene Annuity and Life Company or Athene Annuity and Life Assurance Company of New York as part of the transfer. The purchase of group annuity contracts will be funded directly by assets of the US GE pension plan. He's going to do a number of slides on that piece, folks. In January of 2021, even though it's not United States, another pension de-risking on a global scale, announced today that as part of the continued actions to solidify, there you go again, its financial position, it is proposing to freeze the accrual of pension benefits for approximately 2,800 employees in its defined benefit pension plans in the United Kingdom. A 60-day consultation process with plan members will begin in February. So I guess that's not totally implemented until they do that consultation. If implemented, the proposals will impact all members of GE pension plan and GEAPS. I'm not exactly sure what that acronym stands for, in the UK, and come into effect January 1st, 2022. Affected employees would be automatically enrolled into GE's existing defined contribution scheme, and the company is proposing a temporary increase to the default 10% employer contributions by 2% for the first 2 years. There would be no change for GE retirees already collecting pension benefits. Okay. Ed will talk about what the possibility of changes could be in the future through pension plan de-risking. So to answer the question, why are we concerned? Every fall meeting, now called the Retiree Town Hall meeting, that the National GE retiree reps via benefits and GE, we all meet. We're doing it virtually online these days because of COVID. We've asked the question, do you GE plan to de-risk the pension plan? We were always told no. We have shown you the various pension de-risking strategies that GE has already employed above. And Ed will explain and define the pension plan de-risking and its many component pieces to you. The history and examples given above paint a different picture and part of GE's strategy because it is about reducing its debt and liability, which includes pension plan de-risking strategies. So because of our growing concern at our organization, GE Retiree Benefit Solutions, that's the name of our official name of our organization, Incorporated, we were simultaneously put in touch with Ed Stone through a colleague at Beltel, connected me and Ed just about the same time we were talking on our board about pension de-risking and what's going to happen and what do we have to be concerned about. So Ed came and did a presentation with our board. Our solutions board. That's a short name for our group, Solutions. We were very impressed with his knowledge and expertise on the subject of pension plan de-risking. The Solutions board then decided to set up this webinar for all interested retirees and dependents and other interested GE folks on this subject of pension plan de-risking. So at this point, I turn it over to my good friend, become my good friend, Ed Stone, and his trusty colleague there, Julie, although she's going to be in the background, but she's there. And Ed's bio is here, folks, and it's at the end of the presentation. I'm not going to read this now. And his information is on the bottom of this. All these materials, again, will be posted so you can get your hands on them and review them, plus the video. So Ed, it's all yours, and I got to turn it over to Julie as the host. Right?
Yep.
Okay. And let me go here. And Julie, you're on. Let me say yes. Okay, there it is.
Got it.
All right.
So
Thanks.
while Julie's setting up the presentation, I'd just like to do a brief thank you to John for coordinating all of this and to Connie for helping us run through everything. We do have a lot of material to cover. I've done these types of presentations before, but since I met John, I've been really focusing more and more on the GE specific issues. So this presentation is different than any one that I've ever done before. And so you'll get to see some things for the first time. And some of the material is complicated. So I don't have a problem taking lots of questions. I think, as John stated, to the extent we can wait till the end, it'll make it easier for me to cover everything. And if there's something really that does prevent you from kind of understanding what we're talking about, then that's the time to just shoot out a message to Connie or to Julie, and they'll figure out a way to get it to me at the right time. All right, Julie, you can go to the next slide. So the reason that we're doing this presentation really comes down to a simple question. When is a pension not a pension? Well, a pension's not a pension when it gets de-risked. And it's certainly not a pension when it gets de-risked through the use of a group annuity contract. Pension de-risking has been around for a long time, but it really started to pick up steam in 2012, right around the time that General Motors and Verizon entered into two very, very large transactions. I was very much involved in the Verizon transaction, and I helped the Beltel retirees at that time not only challenge the transaction initially, we wound up taking that case all the way to the Supreme Court of the United States, but we also started to really dig in and analyze what happens after a defined benefit plan kicks out 41,000 people through the purchase of a group annuity contract. And I had just gotten through representing a number of individuals in connection with an insurance company insolvency in New York with the Executive Life Insurance Company of New York. And I had just literally been doing battle with all of the insurance companies there and the guarantee associations trying to get coverage for all the people who are going to get their benefits cut. And a number of pensioners in the Executive Life insolvency did get their benefits cut. And so that kind of led right into my work with the Beltel retirees. So I've really been doing this actively since about 2010. So it's more than a decade I've been at it now. So hopefully over that decade, I've learned something. Okay, Julie, you can go to the next slide. So what's happened here with defined benefit plans started a couple of decades ago when companies started to insert this little tricky language called reservation of rights language into all of the summary plan descriptions and in many other pension plan documents. Your pension plan has a plan itself that governs all of the obligations, and that is subject to the ERISA law. Every year, they're supposed to give you a summary plan description that gives you the highlights of the pension plan, particularly any changes. But a couple decades ago, companies started inserting these clauses that basically say, while the company intends to continue the plan described in this summary, it reserves the right to change, modify, or discontinue the plan at its discretion at any time. That language has been upheld by many courts around the country as being clear and unequivocal. And courts have determined that because of that language, it is okay for the plan to make changes to anything other than a vested benefit, which would be a payment right that you would have that would be protected under ERISA. Okay, Julie, you can go to the next slide. So John, in his opening, really kind of highlighted the different forms of pension de-risking and why it's something that you as GE retirees should look out for. Pension de-risking is any decision by a defined benefit plan sponsor to reduce pension liabilities. The first and most obvious one is freezing pension liabilities. There's two types of freezes. You can have a soft freeze, where they essentially don't allow new people into the plan, or a hard freeze where they stop accruing additional benefits. So once you get to a hard freeze, that's when you know you got to look at what's going to happen next. Liability-driven investing strategies is a way for the defined benefit plan sponsor to focus on matching assets and liabilities better. So that doesn't necessarily result in any loss of benefits or the use of an annuity contract. It's just a different way of investing that's becoming more and more popular, particularly as we've lived through a long period of very stagnant or flat interest rates. The next and most common one that you see in terms of steps towards de-risking is a lump sum buyout. Very often, defined benefit plan sponsors offer retirees and sometimes employees lump sum buyouts of their pension obligations. Don't be fooled, these lump sums are using money that's in the plan. They're just discounting the payments that they're supposed to owe in the future based on their life expectancy calculation and a discount rate that they use to come up with a lump sum, and that gets them off risk for those future payments to the individuals who take those lump sums. Generally, lump sum buyouts are pretty profitable to the plans and can present risks to retirees. It puts the investment risk solely in the hand of the retiree. On the other hand, you have to weigh your risks at the time you're given a lump sum offer and consider whether or not you think that the defined benefit plan is at risk. But a lump sum is not a free handout. It's generally cash positive to the plan, and it's a way for defined benefit plan sponsors to reduce their risk in the future. The next type of de-risking is what I call an annuity buy-in. That's when the plan itself purchases an annuity contract to make payments to plan participants. In those situations, the annuity makes payments, but the participants are still protected by ERISA because the plan is the owner of the annuity contract, and it's not a buyout or a lift out. Those are the ones that I'm going to get to next. Those are the ones that are the most prevalent, and those are the ones that have most recently impacted the GE retirees. So an annuity buyout, which is often done in connection with a plan termination, is when the plan terminates, comes to an end, and an annuity contract is purchased to fund all of the plan's liabilities going forward. And then the individual plan participant becomes a certificate holder under a group annuity contract. It's a little complicated because the individual plan participants don't own the annuity, they're just certificate holders. The annuity is often owned by a subsidiary of the defined benefit plan sponsor. Similarly, with an annuity lift out, what happens there is the defined benefit plan sponsor kicks out members or plan participants through the purchase of a group annuity contract, but it doesn't terminate the plan. That's exactly what happened with Verizon. They kicked out 41,000 individuals, approximately 50,000 remained in the plan. And we argued all the way to the Supreme Court that that transaction had to be discriminatory because there's no way that the people who are left in the plan who had all of ERISA's protections would be treated the same as the people who were kicked out of the plan and became certificate holders under a group annuity contract. We took that all the way to the Supreme Court, and the Supreme Court decided, consistent with a case called Spokio v. Roberts, that if you can't show current economic harm, you don't have standing to challenge one of these pension de-risking transactions under Article 3 of the United States Constitution. And I'll address that a little bit further on in the presentation. Julie, could you go to the next slide, please? Okay, so the pension de-risking annuity path is kind of what John's diagram early on really points to. They start by freezing benefits. They try to make up the pension plan funding deficit. And this is a really important thing to look out for. And it's also something that's very, very difficult to understand. In order to de-risk under ERISA, the plan has to be at least 80% funded. The real debate over 80% funded is what discount rate are you using to calculate the liabilities? Because as some of you know, and all of you will learn as you start looking more and more closely at your annual funding statements, and I would encourage you to do that, a slight change in discount rate can make a huge difference. And if you look at your annual funding notice and the supplement to the annual funding notice, you'll see two categories. One will be adjusted rates and the other will be unadjusted rates. Well, the difference in funded status is tremendous. With adjusted rates, your plan is over 90% funded, or I think it was, and with unadjusted rates, it's below 70. So it's really, really hard to get a sense of how well funded a pension plan is because it really does depend on what discount rate assumption you use. So the key thing to bear in mind is there's really only two key issues for a pension plan. One is how much are they going to earn on their assets? And that's something you'll get a report on every year. Of course, you get those reports quite late, but you'll get a report on how much they earned on the assets in the pension plan. And then you need to know how much they have to pay out in their liabilities. That's the one that's always a moving target. It's a moving target because obviously nobody knows when people are going to live and die. And for the most part, the plan obligations change when someone dies. Most of your plans come with a survivorship option, which will pay a benefit, but a lesser benefit to a surviving spouse. But until people die and until the surviving spouses pass, it's hard to know exactly what the remaining liability is. And that's why they make assumptions about how long people are going to live, and they make assumptions about how much they're going to earn on their assets, and then they make assumptions about what's the value of the liability. So those are really the three key assumptions you see going on, and this happens year over year. Lump sum buyouts have been somewhat controversial, and at some point in time, they were actually banned. And the concern that folks had at the Department of Labor about lump sum buyouts was they thought that it was unfair to put money in the hand of pensioners who might not be well suited to invest their pensions, and that it was much safer for them to get periodic payments for the rest of their life than to get a lump sum that they might squander. And that was somewhat of a protectionist view. My own personal view is it really depends on the individual. Some folks are perfectly well suited to manage a lump sum of cash. others not so much. But there's clearly risk associated with getting a lump sum as opposed to payments over time. I do think it should be an individual choice, but I think that choice should be made in an informed manner and not haphazardly. And so to the extent you do get a lump sum offer, I would encourage you to look at it very carefully, look at the discount rate assumptions that are being used, make sure it's fair, and make sure you have a plan. Number one, to protect that lump sum, because once you get it, it's no longer protected from creditor claims and so on. And number two, that you have an investment strategy in mind, because once you get it, you can never go back to the periodic payments under the annuity. So the investment burden shifts entirely to the retiree. The money that you get is going to be taxable unless in some limited circumstances you can roll it over into an IRA. Do that carefully and properly. You lose the PBGC coverage, which is very important. And I'll go into that in some detail later, including how much coverage there is and how that coverage increases as a function of age. And of course, as I pointed out, those lump sums are not exempt from creditors. Next slide, please. Okay, so what drives pension de-risking? And I'm sure you guys have already figured out this is all about money. You know, companies will often say, and I've read a lot of GE's press release about how much they care about the retirees and their employees, but at the end of the day, they're looking at their bottom line. And what's happened that's really important to understand is that PBGC premiums have risen tremendously. When I first started tracking this in 2012, right after the Verizon deal was consummated, the per participant fee was $35 per participant. This year it's $86, and that's a fixed fee. So that's a fee that they have to pay. Now, the GE plan has some 400,000 participants all told, including actives, retireds, everyone else who's involved. So those fixed fees going up to $86 per participant are quite substantial. However, they pale in comparison to the variable premiums that GE is likely to have to pay. And I say likely because it depends on how funded the plan is. So the variable premiums, and this is determined by the PBGC, and the PBGC does not allow the use of adjusted discount rates for purposes of calculating unfunded vested benefits. So the calculation is $46 per $1,000 in unfunded vested benefits. That number gets capped at $582 per participant. Now, if you took $582 per participant, GE's bill could be in the neighborhood of $232 million. That's a lot of money. And, you know, that's one of the reasons that GE, in my estimation, is looking for ways, you know, to offload the pension to an insurer. The challenge is finding an insurer that's going to take on the risk. And that's what really segues into some of the concerns with certain insurance companies and why it's important to have more transparency and accountability so you don't find yourself with a situation where the annuity company can no longer make good on its obligations and it's too late in the game for you to do anything about it. So some other concerns that defined benefit plan sponsors talk about is financial market volatility. You know, when you're managing a very large pension plan, you take a lot of risk every year. Markets go up, markets go down. You don't know what your funding obligation is going to be. And it's important, you know, to focus on core business. So sometimes it becomes quite a chore to manage that volatility. The funding rules are very strict. And so there are minimum required contributions based on the funded status every year. And that can be quite a chunk of change. And so in addition to managing volatility, you have to make sure you have enough cash to make those minimum required contributions under ERISA.
Ed, can you explain PBGC, what that acronym stands for?
Okay, perfect question and a good question to ask while we're talking instead of at the end. PBGC is the Pension Benefit Guarantee Corporation, and the PBGC provides benefits to, provides a sort of insurance coverage to defined benefit plans that get into trouble and get taken over. So if a defined benefit plan fails or a company goes bankrupt, then the PBGC will step in, take over the plan, and make benefits subject to certain limits that I'll go into later. Is that a clear enough explanation for you guys?
Very
It's a
good.
part of ERISA. They're not directly funded by the federal government, but they are a part of ERISA. Okay, so going back to actuarial uncertainty, as we discussed earlier, one of the key issues is how long people live and how long people die. Pension plans constantly make actuarial assumptions about the future payment obligations they're going to take on. Sometimes actuarial tables get revised and those assumptions have to change. So this creates all sorts of uncertainty for the defined benefit plan sponsor. Again, the cost of managing a pension is not insignificant. I just saw a note about GE being a single employer for the PBGC. That's correct. The PBGC has two programs. One that impacts GE is the single employer plan, which is in relatively good financial shape as of today. And then the other is the multi-employer plan, which is in pretty bad shape, although they did just get some relief under the recent passage of the Secure Act. But yeah, there's two different, essentially two different components of the PBGC. And then one of the things I hear all the time is that businesses are getting more and more complicated generally, and companies want to focus on their core business, and managing a pension plan is just too much work. So those are the real reasons, all of them really financial. Next slide, please. Okay. All right, I talked a little bit earlier about 2012 being kind of a key date for me. Sometimes when you read articles, and John and I share a lot of articles, particularly of late, about pension risk transfer, because it seems to be really on the rise again. Pension risk transfer and pension de-risking, for your purposes, they're the same thing. Since 2012, literally millions of retirees have been kicked to the curb by the company they work for, and now they receive their benefits from an insurance company. Now, I think it's important now just to take a step back and understand that although we're going to go into a lot of details about some of the things that I think are important to focus on, I'm a realist. Pension de-risking is not going away. It's going to continue to happen. I think the goal of everything that I try to do as a retiree advocate is to make these transactions more transparent and make the insurance companies more accountable, and the defined benefit plan sponsors, so retirees know where they stand. A pension, as you guys all know, is an earned benefit. It wasn't a handout. It was part of your compensation package. Many of you traded higher salaries for a benefit package. So when that package gets threatened in any way, you have good reason to be concerned. But there's no chance that we're going to stop defined benefit plan sponsors from offloading pension risk onto annuity companies. It's just not going to happen. And in some respects, it's not a bad thing. A properly managed annuity company should be well suited to manage long duration liabilities. And that's what a pension plan is. So done right, pension de-risking doesn't have to be a bad thing. The problem is there's a lot about the way it's done now that is very opaque. And so what I'm trying to do is pull back the onion a little bit and educate folks about what the important concerns are so you can protect your earned benefits. Next slide, please. So we talked about annuities. We talked about the annuity buy-in. We talked about the buy-out, and we talked about the lift-out. So Julie, you can go to the next slide. What's important to understand about a de-risking transaction is what retirees lose. So under ERISA, retirees have uniform protection from creditors. Creditors can't get at plan participants' payments under a defined benefit plan, period, end of story. There's a limited exception for a qualified domestic relations order, and that's it. Under annuity contracts, it's a whole different world, and we'll explain that a little bit later. Under ERISA, plan participants are supposed to have dispute resolution procedures and ready access to the federal courts. There are penalties written right into the law, and the plan sponsors and anybody who's deemed a fiduciary is supposed to be held to the highest of fiduciary standards. Now, I'm going to note, and you'll see in the next couple of slides, those fiduciary standards under ERISA have been eroded by the courts in recent years. That will change over time. They will come back. but it's not going to be uniform, and it's something that we have to fight for. It's very important because when ERISA was signed into law by Gerald Ford in 1974, it was done to protect employees and retirees, and to protect in particular their earned benefits. And they, at that point, stated that the ERISA fiduciary duties were the highest fiduciary duties in the land. Recent federal court decisions and Supreme Court decisions have undermined that standard. So I expect you'll see more of that in the courts in years to come. As you probably know, as retirees under a defined benefit plan, you get an annual statement. That annual statement contains some pretty detailed information. It gives you a sense of how well funded the plan is and what the shortfall is. And it forces the plan sponsor to provide you with a number of disclosures. That's an important thing. That's the most information that you get. You also get a Form 5500 that you probably received that has to be signed off by an actuary that goes into a whole bunch more detail about what the pension trust is invested in. And finally, and perhaps most importantly, all ERISA plans have access to and coverage from the Pension Benefit Guaranty Corporation. Next slide, please. Okay, so a little side-by-side, apple to orange comparison. The pension federally protected under ERISA keeps creditors at bay, detailed annual statement, fiduciary responsibility. Plan sponsors are supposed to act in the best interests of plan participants, and the PBGC coverage is a lifetime of monthly payments subject to certain caps that I'm going to go into in a minute in case your employer goes belly up. Under a group annuity contract, you default to non-uniform state laws. Those state laws are relevant with respect to guarantee association coverage amounts, and those state laws are also relevant to creditor protection and to how an insurance company gets managed in insolvency. Under the McCarran-Ferguson Act, the business of insurance is relegated to the states, which means that depending on what state you're in, you're going to have a completely different regime for how they work their liquidations. Insurance companies can't file bankruptcy, so they file for liquidation under state law. Guarantee association coverage is very different from PBGC coverage. Guarantee association coverage includes assets that are already in the company, and it tops it up to a limit that is set by statute. That limit is per individual per lifetime, and those limits are capped. Today's limits range from $250,000 to $500,000 per individual per lifetime. Now, for some folks, that might be reasonably equivalent to what the PBGC provides, depending on your age and depending on how long you live. But for older retirees, it's not anywhere close to what the PBGC offers, and you cap out at that $500,000 amount. And that's only 4 states that provide $500,000 in coverage. Most states provide $250,000, and there's a handful of states that provide $300,000 in coverage. By the way, if after this call you want details about any of this in any individual state, please contact me either through John or Connie or directly, and I'm happy to provide that information. We track it on a regular basis. Next slide, please. Okay, the Pension Benefit Guaranty Corporation, and I should have explained that when I first introduced it. It's a US government agency designed to protect retirement incomes for private sector retirees. It doesn't apply to public pension plans. It does not take in any tax dollars. It's funded by the insurance premiums from companies with defined benefit plans. They take over if a plan goes belly up or if a plan fails. The PBGC also watches defined benefit plans that are required to report to the PBGC on a regular basis and in connection with the premium payments that they make, because the PBGC is allowed to assess variable rate premiums if a plan falls below a certain funded status. So the PBGC, in addition to providing coverage, is kind of a watchdog for your pension plan. So it provides a very serious benefit in that regard, because it's not supposed to allow companies to get into a situation where it gets so underfunded that it's at risk. If that happens, the PBGC can step in early on and take over the plan. And then they would address the plan takeover with you directly. And that has happened. And it also happens in situations involving bankruptcies. Okay. So for 2021, the maximum annual benefit for someone who retired at age 65 is $72,409.68 for a straight life annuity, meaning no joint and survivor benefit. And it's $65,168.16 for a joint and 50% survivor annuity. So those joint and survivor annuities pay benefits to a surviving spouse until the surviving spouse passes. These are all choices that you would have made prior to taking your benefits, because you can't change those choices once you make them, because the plan sponsor calculates its liabilities based on whether or not you have a straight life annuity or a joint and survivor annuity. You may have been offered many different options over the years, so you should always check and keep handy what choices you made. One thing that I noticed with one of my other clients, the DuPont retirees, they were spun off to a new company, and the new company is claiming not to have the records of the joint and survivor election that were made. Now, I think that's a bunch of hogwash, but because they certainly should get it. But just in case, I would recommend that all of you keep those records somewhere safe. It's very important, obviously, for your estate planning. Okay, here's the key. For 2021, the maximum annual benefit at age 75, $220,123.56 for a straight life annuity, and $198,000 or so for a joint and 50% survivor annuity. So those amounts are pretty significant at age 75. When you compare that to a lifetime cap per individual per lifetime of somewhere between 250 and 500,000, you're almost at the 250 level in 1 year, PBGC versus Guarantee Association coverage. So when folks say that Guarantee Association coverage is equivalent to PBGC coverage, what I would say is that's not true. It's just not true. And if you do the math, you'll see it's not true. Okay, the main reason it's not true is because PBGC benefits increase each year as a function of age. And those benefits are approved by Congress on an annual basis. Next slide, please. All right, so I get a lot of questions about what state guarantee funds are, how they operate, and what happens when Guarantee Association coverage is triggered. And these are kind of complicated issues because, to be fair, you don't see a lot of life insurance insolvencies. However, there have been a number of notable ones, including insolvencies involving the executive life companies. And there are right now a number of insurance companies that are facing insolvency, particularly companies in the long-term care business, which is under a tremendous amount of pressure. So what is a guarantee fund? A guarantee fund is a voluntary post-insolvency assessment vehicle. That's a complicated way of saying they have no money. They assess their members. Their members are other insurance companies that write life insurance or annuity business in a particular state. They provide coverage by statute up to a set amount that ranges from $250,000 to $500,000. Coverage is determined by an individual's state of residency at the time of insolvency. The actual definition is the time of insolvency or impairment. And again, this is something that's determined under state law. Some state laws require a finding of insolvency. Other state laws require simply a finding of impairment. But in any case, once there's a finding of one or the other, Guarantee Association coverage is triggered. And then the Guarantee Associations get involved, and they're usually coordinated by an organization called NOLGA, which, if I remember correctly, it's the National Organization of Life and Health Guarantee Associations. I think I got that right. But it's a group of all of the life and health guarantee associations. And so they get together to manage complex multi-state insolvencies. And again, as I pointed out, the contributions and assessments that a company can make on its members are limited by statutes. And that's what I think is really important. In other words, if a large company went into insolvency, it's not a lock that the guarantee associations would be able to raise enough money to make good, because most of them are limited in how much they can assess their members. And it's usually a percentage of premium written in that state. So for example, in a state that has a lot of annuitants, like say New York, there might be a lot of premium dollars flowing in, so the assessment amount could be quite high. But in a smaller state, say North Dakota, there might not be as many individuals, and therefore there might not be that much premium. And then those guarantee associations might not have the ability to assess their members enough to make good even on those minimum amounts. So guarantee associations are not the same as the PBGC. Next slide, please. Okay, so why should you guys care? Well, we talked a little bit about the difference between ERISA and uniform protection versus state mandated state protections that impact annuities. And that turns to, what are the risks associated with these annuity providers? Well, one of the biggest risks is concentration risk. There's a handful of companies that participate in this business, and I have a slide later that lists most of them, or all of them. But the vast majority of the business is handled by a small handful of companies, with Prudential far and away being the largest, and Athene being the one that's growing the fastest. So Prudential has roughly 1/3 of the total amount of de-risked pensions on its balance sheet, and Athene is growing fast behind Prudential. But after that, it falls off into small transactions. So there's a very high concentration of risk in the hands of mostly publicly traded life insurance companies. We learned during the financial crisis that no one's too big to fail. I know that my father once owned stock in Lehman Brothers. That was completely wiped out, and it was rated A for years and years and years. The amount of money that's at stake here, you'll see later the exact amount. I think from memory, it's $177 billion, but it's hundreds of billions of dollars is at stake, and it's continuing to grow. And, you know, that's all of a sudden a very meaningful sum of money. And we learned also during the financial crisis that a lot of these companies are related. They share risk with one another. And so a failure of a large life insurance company could be catastrophic for financial markets, let alone for retirees. I have been doing a lot of work digging into how insurance companies account for their liabilities and how they report over the years. And I've been in particular focused on the publicly traded life insurance companies, because there's been a lot of movement by publicly traded companies to purchase other insurance companies or other lines of business. In the old days, the biggest insurers were mutuals. Mutuals are owned by their policyholders. They didn't have the pressure to report with 10Ks and 10Qs and things of that nature. It's very, very complicated to dissect the public filings of a holding company like Prudential Financial or Athene that owns life insurance subsidiaries. So I've been following this for a decade now, and it's very, very, very complicated. And they've been using what I call financial alchemy to make it look like they have more in assets at the ready than they actually do. And that's really a concern. And that's something that I think we can shed a light on, and that would help force more transparency and more accountability. And we'll walk through that in some detail later on. The other issue that we're going to talk about today is one of the servicing related disasters that made the news involving MetLife. And I'm sure some of you read about it. Essentially what happened was MetLife was accused by the SEC first, and then by the Department of Financial Services of the state of New York, of failing to use appropriate measures to locate retirees. And essentially what happened was all they did was send out a couple letters. And then if they didn't get a response to the letter, they assumed the retiree had passed. And after a while, they took the money. And so they went through this process and they found that, lo and behold, there were quite a bit more retirees that were quote unquote lost than MetLife had let on. Next slide, please. So in 2018, MetLife forgot to pay tens of thousands of retirees, 2 letters, 5 years apart. That's kind of ridiculous. I mean, all they have to do is automate the system to send out a letter. They also have access to what's called the master Social Security Master Death Index. They didn't use that. They just assumed they weren't there. So they found out as a result of this inquiry that 80% of the folks that they presumed to be dead were actually alive. So they had to fix that. In January of 2019, Department of Financial Services hit them with a fine of $19.75 million. And the SEC out of Massachusetts, I'm not sure why it was Massachusetts, but they slapped them with a $10 million fine for pension accounting violations. And guess what they did just later that year? They got right back into the pension risk transfer business. Next slide, please. So for them, for MetLife, the fine was really just a slap on the wrist. But what I didn't say on the other slide is MetLife put over $500 million back into reserves. And they didn't do that because they were being kind to retirees. They did that because they had already taken out $500 million in reserves. So that's the part that kind of got swept under the rug. But that's the part I think that's really telling. Okay, so John and I started talking. Lo and behold, what happens? General Electric transfers $1.7 billion in pension plan obligations for 70,000 retirees to a company called Athene. Athene is a relative newcomer in the pension risk transfer business. In fact, Athene was only formed just after the financial crisis. I think it was in 2009. So it's not a long-standing mutual company with tons of experience. They do have experienced practitioners. They do have a lot of capital under management, but as we'll see in the next slide, it's really a convoluted picture when you try and fight through what Athene really is. Next slide, please. Okay, so Athene Holding Limited is publicly traded on the New York Stock Exchange, but it's a Bermuda-based holding company, and its primary regulator is the Bermuda Monetary Authority. That's an important fact. And that's what Athene has done that's different from a lot of the other companies. A lot of the other companies use the same techniques and strategies that I'm going to show you a little bit later, but Athene is the only one that's owned by a Bermuda-based holding company. What's very interesting is that Athene always states in all of its public documents that it, the holding company, is not responsible for the ongoing insurance policy and contract obligations of its subsidiary insurance companies. That's important, and you'll see in the later slides why that's important. Athene was also recently fined by the Department of Financial Services of the state of New York for violations related to its pension risk transfer business. Essentially, what Athene was doing was they were writing the business out of a company that wasn't licensed to do business in New York, and New York doesn't like that. New York wants reporting done specific to New York residents. So they were fined $45 million, and they agreed that all of the business that was done that impacted New York residents would be done through their New York affiliates. And on a slide that I'm going to show you in a couple seconds, you'll see where all those affiliates are in the org chart. The other interesting thing about Athene is that Athene was created by Apollo Global Management. Apollo is a private equity fund run by Leon Black, who's been in the news of late, none of it good, mostly about his affiliation with Jeffrey Epstein, and he recently stepped down. But Apollo, what most people don't know, Apollo was created with assets that were literally stolen from the Executive Life Insurance Company of California way back in the day. Leon Black made a tidy $3.5 billion profit and founded Apollo. Apollo makes 1/3 of its income on Athene investments. So that's why they like the insurance business. They consider the annuity business in particular to be sticky capital. And we'll talk a little bit about more later. So recently announced, Apollo is going to take over 100% of Athene. That's supposed to close in January of 2022. So keep your eye on what gets published in the news. I'm sure there'll be more and more about that in coming months. Athene's done a number of other large deals in addition to the one that they did recently with General Electric. They've also done transactions with Bristol Myers Squibb, Dana Corporation, Lockheed Martin, and most recently with JCPenney. As many of you know, JCPenney recently went into bankruptcy, and Athene stepped in and took over a bunch of those liabilities.
Ed, can I say something right here?
Of course.
Apollo, I have experience with Apollo Private Equity Company. GE Silicones up in Waterford, New York, was originally sold to Apollo. Apollo basically, over a 3-year period, ran that company into the ground, decimated our wages and our benefits, and ended up leaving us bankrupt. And then they reorganized, and right now the GE Silicones is owned by the Koreans. So what I'm saying to you is I have a bad taste for Apollo Global Management, and them in the picture, along with what Ed is explaining about Athene, that raises the hair on the back of my neck. And, it's very important we pay attention to this piece, especially I've already raised my concerns to GE about Apollo and Athene after learning this. And we'll see where it goes in the future if they should do any more de-risking strategies. So I just wanted to share that with you. Okay.
No, I think that's a good point. I mean, look, the good thing about Apollo is they tend to make a lot of money. The bad thing about Apollo is they tend not to care about policyholders or retirees. So I will be talking about the things that I know about Athene as we go through this presentation, but I will tell you something that I am concerned about, but that I don't have 100% clarity on because I haven't had an opportunity to dig into how Athene got started and what those assets really look like. But my suspicion is this: Athene was created right out of the financial crisis. The assets that were hardest hit during the financial crisis were the structured products, the mortgage-backed obligations, the option arms, the Alt-A investments, all that kind of stuff that was tied to the mortgage industry and to the structured finance industry that was sold off and sold off and sold off, that made gazillions for investment banks, but left a lot of folks holding the bag when we faced that liquidity crisis in 2008 that ran into 2009. Apollo had tons of those assets on their balance sheet. When you create an insurance company, you don't have to mark things to market. You can mark these types of assets as hold to maturity. So there could be a lot of assets on Athene's balance sheet that are hold to maturity assets that might be much riskier than people think. And I'm just going to leave it at that. But that's one of the things that I've always been concerned about. And the reason is they grew to be huge in a very short time. Typically, insurance companies are kind of steady growth companies. They grow slowly and deliberately. Athene, by comparison, has rocketed. And when things go up really fast, they unfortunately have a tendency to come down really fast. So there's reason to be concerned. I think the good news is that Apollo has made a lot of money. And I think by shining a light on this, we'll get more transparency and accountability. But to the extent that the hair raises on the back of your neck, I think it's a well-founded fear that you have. Yeah. Next slide, please. Yeah. Okay. So just to make it simple, I'm not going to go through every aspect of this, but this is basically the Athene Group structure. And as you can tell, there are all these non-insurance entities that are related and all these insurance entities, and all of them are ultimately owned by this Athene Holding Ltd at the top. But what's important to know is that the big entity that owns the insurance and has most of the insurance obligations is this Athene, I'm sorry, let me find the right one. Athene Life Re Limited, and that's a Bermuda entity. So underneath that, you have Athene USA, which is a US company, and underneath that, you'll have another annuity, another Bermuda entity, which is Athene Annuity Reinsurance Limited. And then to the right of that, you'll have a Delaware company that's Athene Annuity and Life Assurance Company. And then connected to that is an Iowa company, that's a reporting company in Iowa, that's Athene Annuity and Life Company. And then off to the side, because of what happened in New York, as I discussed before, you have Athene Annuity and Life Assurance Company of New York and Athene Life Insurance Company of New York. So it's really hard to work through the statutory financials of all these different companies and reconcile them with the public holding company up above. And the reason I'm pointing it out is just so you know, you can't just look at a rating that's given to a company like Athene and think that that's all good. You got to look at what business they're in now, because the businesses that they're in now and what they're doing now is what's going to impact their ability to make good in the future.
And
That's just a,
they're financials that are very hard to figure out, right? Once you break it down to those lower levels, it's very hard.
I don't want to toot my horn, but I'm pretty good at digging through this stuff. It is a nightmare.
Yep.
It's an absolute nightmare because the holding company files on a GAAP basis, the insurance companies file under statutory accounting principles. They don't reconcile them. They aggregate all of those entities and they file on a consolidated basis. So you really don't get a handle on how well reserved the insurance companies are. And I'll talk about that in the next slide. So Julie, could you go to the next slide, please? So this slide is a little bit complicated, and I'm going to try and explain it as best I can. I expect that some might have some questions at some point, and I welcome them. So this is really showing the money that's flowing via reinsurance among Athene affiliates. All of these companies are affiliated with one another. They're all owned by the Athene family. So what it really means is that instead of the regulated life insurance company that issues the group annuity contract holding all of the liabilities and all of the assets, they have taken a good part of those assets, in most cases 80% or so, and a good part of the liabilities, and transferred them to a wholly owned subsidiary called Athene Annuity Re in Bermuda.
Right.
So from the get-go, 80% of the risk is with a Bermuda company and not with a company that reports under United States regulations. And that's something that people don't really realize. They disclose it, but in a way that's not apparent.
Eddie,
Yes.
we have a couple quick questions. One from Bob Dayhoff. He wanted to know, is there any chance that GE could own part of this Athene Bermuda?
Could GE own part of Athene Bermuda? I imagine it's possible. It would be more likely that GE could own stock in the Bermuda holding company.
And then Alex Brown wanted to know if you could explain what reinsurance is.
Oh, that's a great question. Okay, Alex, that's a good question. I'm sorry for jumping ahead. So insurance, as you guys kind of know what insurance is generally, because you see it for life insurance, health insurance, car insurance. Insurance is something that an insurance company will provide to an individual. Reinsurance is insurance that a reinsurance company provides to an insurance company. So it's really a form of insurance on insurance. But in this case, it's not typical because this is all reinsurance with affiliates. That's what's unusual. Reinsurance in and of itself is just one insurance company sharing risk with another insurance company, basically. And a reinsurance company only provides that type of insurance to an insurance company. Is that clear? Okay, I'm going to assume that it is. If not, I'll address that later.
Eddie, one other thing. Melody Jackson wanted to know, reinsurance can't be licensed in every state?
It can. Any company that issues reinsurance is going to be regulated by the state that it is domiciled in. So, for example, of the ones that are reinsurers, Rocky Range happens to be a reinsurance company. It's licensed it's domiciled in Arizona and regulated under Arizona law. But it is a captive reinsurer, so it doesn't publish financial statements. Athene Annuity Re is going to be domiciled in Bermuda, and it's regulated by the Bermuda Monetary Authority.
What about the two New York?
Those companies would be regulated under New York state law.
Okay, they're
New
not
York
in this
insurance.
graphic, but they are regulated in New York.
Yes,
That's what
yes,
I'm saying. All right.
yes. This is really just to show the reinsurance that's going around among the group. The real issue, I think, for you guys to bear in mind is, as of December 31, 2020, 86.9 billion in liabilities are held by Athene Annuity Re Limited, a Bermuda company.
Yeah,
And that's important because at the end of the day, they're not regulated under Iowa state law or Delaware state law, and they can count things as assets that would never be permitted in a regulated insurance company. I can give you a couple of examples. Bermuda companies can count surplus notes as assets. Surplus notes are really debt, but they're allowed, for some crazy reason, to count them as an asset. They also are allowed to hold conditional letters of credit as assets. Again, that would never work at a regulated insurance company. And finally, they hold parental guarantees as assets. That would never work at a regulated insurance company either. And they also will use things like letter of credit like, or LOC like. And I don't even know what that is, but they're allowed to count as assets in Bermuda. So the concern is that once the money leaves the regulated company, it gets replaced with a reinsurance agreement, which is essentially an IOU. And the real question is, can Athene Annuity Re Limited make good on the 86.9 billion it owes to the various different insurance subsidiaries? Next
Eddie,
slide,
I think
please.
this goes to that. The question was if Athene Bermuda were to go bankrupt for some reason and the GE pensions were held with them, would they be given any protection?
Yeah, well, once the pension, okay, so that's an excellent question and a super complicated one. So leave it on this slide. So once a de-risking transaction takes place, the pension will take the form of what's called an allocated group annuity contract. That contract will be issued under state law. In all likelihood, with Athene, it would be a combination of Iowa and New York law for the New York residents. So those contracts, if Bermuda were to go into bankruptcy or insolvency, those contracts would remain in force. And those licensed and regulated companies would still be responsible for administering and making payments on those contracts. What the question that I can't answer is if that company goes bankrupt and doesn't have sufficient assets to make good on its IOUs, what impact would that have on Athene Annuity and Life Company and on the New York entities? That's a question I don't know the answer to. It depends. It depends on what they have at that time. But that contract would be governed under Iowa law and or New York law, and it would get the benefit of the Guarantee Association coverage, which would run to the individual plan participants based on their state of residence at the time of insolvency. But the key question that I don't know the answer to is what happens if Athene Annuity Re Limited goes into bankruptcy? What impact would that have on Athene Annuity and Life Company? I believe it would be pretty significant, but I don't know for sure what would happen. Go to the next slide, Julie. Okay, so what Athene and Apollo have done is really perfect this kind of triangular relationship that goes below the holding company among a life insurance company, an offshore captive reinsurer, and a captive asset manager, which in this case is Apollo. Apollo loves Athene because it gets to manage all of the money. Apollo manages money for assets that are held at the Bermuda holding company level, at all the regulated life insurer levels, and even at the offshore captive reinsurer levels. So the more money that Apollo can manage, the more it makes in fees, the happier Apollo is. But the real issue, as we saw from the previous slide, is what's left at the regulated insurance company level. So this little triangular relationship is important. And I think it's something that we're going to see more and more of. One of the reasons you see more and more of this might not make you jump up and down, but after the financial crisis, banks became much more conservative. A lot of the rules changed about prop trading, and there's a significant more oversight of banks, large banks in particular. As a result of that, more and more life insurers got into the commercial mortgage business, the structured product business, and commercial lending businesses. So now a lot of these life insurers are in those businesses, and they hold those assets. And those assets obviously are more volatile than traditional corporate bonds.
Eddie, can you
and then-
explain what captive means in this place? There was a question.
Sure. So a captive is a company that is wholly owned by another company. It's called captive because in a typical reinsurance transaction, a life insurance company enters into an arm's length reinsurance treaty or contract with a third party. That third party takes in a premium and agrees to make payment in the event certain things happen. And there's a number of different types of reinsurance arrangements. A captive reinsurer is a reinsurer that is owned 100% by the life insurer. So it's set up for the sole purpose of reinsuring the life insurer's own risk. So when Athene transfers assets and a liability, in this example, one is life insurer, call that Athene, transfers to, I think it's called Rocky Range, its liabilities and its assets. Rocky Range then gives a reinsurance agreement back to Athene. It's the same risk, just moving it from one bucket to the next. And that's why it's called a captive reinsurer, because it's captive to the life insurer. Is that clear, everybody? So Athene is not the only company using this strategy. It's the only one that has a Bermuda holding company at the very top. This is becoming more and more prevalent. You see it with Prudential. You see it with MetLife. And I expect that you'll see it more and more. But Athene is the most aggressive at keeping all three of those entities, the life insurance entities, the offshore captive reinsurer, and the captive, I'll call them a captive asset manager, which is Apollo, all in that same triangle. And this is something that, really folks need to pay attention to, because this is continuing to happen, and I expect it's going to happen more and more. Next slide, please. Okay, so here's a list of, as of 2020, all the companies that have participated one way or another in the pension risk transfer business or in the pension de-risking business. This is all the ones that I was able to gather, all told. However, I can tell you 1/3 of all of the dollar amount of risk transfers is held by Prudential. Other big ones are MetLife, Mass Mutual, and Pac Life. Those are kind of the big ones. You tend to see the pension risk transfer business being bid on aggressively by publicly traded life insurance companies, as opposed to the large mutuals like New York Life Insurance Company. One of the reasons I believe this is the case is because mutuals are owned by their policyholders. They don't use, or they certainly don't abuse, captive insurance structures the way some of the publicly traded companies do, and they don't manage for earnings. They don't have to publish 10Ks and 10Qs, and all their benefits flow through to policyholders. So to the extent that I had New York Life involved as in a reinsurance transaction or in a pension risk transfer, I would be very happy with that. Same with Pac Life. Not so much with Prudential, not so much with MetLife, not so much with Athene. And again, it's not that they're going to go belly up tomorrow. It's that I don't think their disclosures are clear and capable of analysis without really, really, really digging in. Next slide, please, Julie. Okay, so, when I was talking with John, his big concern was with Athene having this Bermuda offshore affiliate, and it's out of the country, and that raised some concerns. Well, if you look at Prudential, even though they don't do anything offshore, with the exception of the business they do with Japan, and those are really related to their Japanese businesses, they have literally hundreds of billions of dollars in related party transactions with captive reinsurers located in Arizona. Now, why do they have so much reinsured with an Arizona captive? Well, to break this down and make it simple, this is something that folks call regulatory arbitrage. Insurance companies are required to hold assets in certain categories. And there are guidelines that are published by the NAIC, which is the National Association of Insurance Commissioners. And those guidelines create tiers of assets. Tier 1 being the lowest perceived risk. That would be corporate bonds or US treasuries, followed by corporate bonds, things of that nature. And then as you go down in number, the risk profile goes up. Well, there are also regulations that require reserves in certain amounts. Those reserves, many of these publicly traded life insurance companies have deemed to be excessive. They don't want to hold that much in reserve because that limits what they can invest in. So they've been able to bamboozle their state regulators into allowing them to substitute real assets or reserves with a reinsurance contract issued by their own captive insurer. Now, I'm not saying those captive insurers don't have money in them. They do, but I don't know how much. And I don't know what they do with it. And I don't know what they earn on it because they don't report publicly. And all of this stuff gets published on Prudential's financials on a consolidated basis, so you can never tell. So you'll have amount due from affiliates, but you won't really know whether or not one of those Arizona captives has made a lot of money or lost a lot of money. Again, it's the same issue that we highlighted with Athene. Are those IOUs going to be money good when it comes time to pay? And what risk is there that they're not? And if they're not money good, that will create a problem for the regulated insurance companies. And when you look at Prudential Insurance Company of America, which is the primary issuer of group annuity contracts, they're the issuer of the Verizon contract and the GM contract. The Verizon contract is 8.6 billion, by the way, and GM is 25 billion. So these were really chunky, very sizable transactions. Their surplus, which is the buffer that they hold over and above the regulated assets versus their liabilities, is 11.5 billion. Now, in the abstract, that seems like that's a pretty good number, right? But 11.5 billion is not that much when you have 100 billion that's been transferred to your own captives. So this is something that I follow on a regular basis and something that I think I'd like to see stop, or at least be curtailed, or at least force the Arizona captives to report on an annual basis in terms of what they're invested in. And that way you'd be able to compare that to what a regulated insurance company would be able to invest in. So that's one of my ongoing goals, is to constantly monitor this and report on it as much as I can to retirees. I know this is a complicated slide, and if you do have questions, I'm happy to take them later at the end. I just saw a little comment about AM Best, about whether AM Best keeps an eye on companies that might catch part of this offloading. They should. You know, they should. I don't know how much they do, but I've thought about engaging with them. But AM Best does give ratings to insurance companies. So do other rating agencies, but AM Best is the one that most people look to in terms of claims paying ability, because they track the claims paying ability. I haven't shared this with AM Best, and Prudential might get mad at me if I do, but they should track this kind of stuff. And they know about it. I'm not the only person who's written about it. There've been some articles in some journals, and there was even a paper published by the Federal Reserve about risks associated with insurance companies. And if any of you want to read up on it, I'm happy to share that information with you. So there are people who are writing about this because they see more and more of it, and folks are rightly concerned about what happens if there isn't enough there to make good on these big bets. And also, you know, you'll see in the next slides, the amount of money that's been transferred in these de-risking transactions has reached enormous proportions. Next slide, please. So pension de-risking is big business. Right now, the amount of assets, the amount of liabilities, I should say, that have been transferred to insurance companies is in excess of $178 billion. I say in excess of because I know this doesn't include the JC Penney numbers and other deals that were closed in the first quarter of 2021. And every time I do a presentation like this, that number goes up. And every time I ask Lisa, who works with me, to update the numbers, she cringes because it takes a lot of time. It's very hard to find this stuff. And, you know, all we see is these numbers going up and up. They've never gone down. And that's a lot of billions. And that's one of the real reasons why we're super concerned. Next slide, please. All right. So this gets to what I've been doing now for the past decade or so. And that is trying to advocate at the state level for reasonable legislation to replace the protections that retirees had under ERISA when their pensions get de-risked through the use of a group annuity contract. Next slide, please. I started out really on this effort by going first to the National Conference of Insurance Legislators, or a group known as NCOIL. NCOIL meets fairly regularly, and they get together folks from all the different states to discuss insurance regulation and insurance legislation. And I went there with the goal of trying to promote a model act for pension de-risking. I was very concerned about the facts that retirees didn't know what happened after their pensions were de-risked, and I wanted them to put in place certain requirements so that retirees would be better protected and better informed. So if something happened, they would know what to do next. I learned during this process that I was never going to get the Model Act passed, but I did get the okay to pursue a best practices resolution. And that best practices resolution was meant to encourage states to adopt legislation that hit on some of these key principles. And again, we wanted to make it so that creditors would be, that retirees would be protected from the claims of creditors in a uniform manner. So if a state allowed for creditors to get at annuity contracts, we wanted to stop that. We wanted to make sure that the garnishment rules were made uniform to dovetail with ERISA. We wanted to make sure that insurance companies couldn't simply transfer their obligations to a less solvent insurance company. And the example they always give is, you know, if Prudential holds the risk today, we don't want Prudential to be able to transfer to the Eddie Stone annuity company. You guys certainly wouldn't want that.
No, we
So we
want
wanted to
John
make
Phelps.
or the John Phelps annuity and assurance company. But yeah, so, and that seems like a reasonable request, right? Because the whole notion of this transfer is that the defined benefit plan sponsor under ERISA is supposed to choose the safest available annuity provider. And that's an issue that I have with Athene, by the way. But leaving that aside, once that insurance company takes over, you don't want them to be able to offload their risk to somebody that's less well capitalized. And we wanted some supervision at the state level. And we really, really, really wanted disclosures, information, all the stuff that individuals needed to know once they were de-risked. We wanted that to be required, to be a requirement on an annual basis, so that folks weren't left in the dark. And, you know, I was very pleased to have gotten this best practices resolution passed. Unfortunately, you know, at the state level, we've made a lot of efforts and we've made some headway, which I'll go into in the next slides, but the best practices haven't been as well endorsed as I had hoped. Next slide, please. We had some success in Connecticut and also in Virginia. We've had laws introduced in Massachusetts, New York. There's one currently live in New York I'll talk about in a bit. We've had them introduced in other places and we've had them reviewed in other places. But we did get a law passed in Connecticut. Could you go to the next slide, please? And Connecticut law really dealt only with one issue, which was creditor protection. We went back and offered up another law over the past couple of years involving the subsequent transfer issue and disclosures. We got all the way through committees, and unfortunately, because of budget issues that dominated during the session, We didn't get to the finish line. We went all the way to the House floor, but Connecticut is still receptive to additional de-risking laws, and they're still very educated about this issue, thanks to our efforts in the past. I had originally done this on behalf of the Association of Beltel Retirees, and this was a big win for us. Next slide, please. We also, in addition to the Beltel retirees at the time, there was a company called protectseniors.org. They also sponsored this legislation. They have since gone out of business, unfortunately, and I'll talk about what we've done after that in a little bit. But the Virginia bill is one I'm quite proud of, because not only did we deal with creditor issues, we talked about disclosures, we never got the disclosures to stick, but we got them to agree on limitations on subsequent transfers. So under Virginia law now, if an insurance company wants to transfer an obligation from company A to company B, they either have to get the approval of the insurance commissioner, or they have to transfer it to a company that is rated A or better by 2 or more nationally recognized rating agencies. So I think we broke some good ground in Virginia. And the model that I developed in Virginia, I think, is one that I'd like to use a whole bunch going forward, because we used a retiree as a representative. I did all the work behind the scenes in terms of drafting the position pieces, the memoranda of understanding, and actually even drafting and revising the legislation. But it was all presented by a retiree rep. So, if you guys get interested and more involved, hopefully you'll be helping out on that level as well. And I find that when retirees reach out to members of the legislature, they pay attention. You are powerful constituents, because your reps know that you vote early and often, and that's something that they really care about. Most politicians want to be reelected, so I will be, without a doubt, using this strategy more and more in the future. Next slide, please. So what we did find is that the insurance industry really does fight these reforms tooth and nail, and in particular, they fight disclosure. And, that's troublesome, but you got to take what you can get. So if we can get restrictions on subsequent transfer and we leave disclosure on the table, we do that. We always put it in every draft bill, because we want the members of the legislature to be aware of it. And frankly, we want to push a vote when we know we have the votes. But if we don't have the votes and we have to take it out, that will give us something that we can compromise on, and we fall back on creditor protection, which they don't seem to oppose too much, and subsequent transfers where they're kind of lukewarm. They don't like it, but they acknowledge that it's reasonable. Next slide, please. So these bills right now are currently pending in New York. This is a bill that I've worked on. It's a kind of a variation of a bill that I've been working on for a number of years. I've been working with Assemblyman Peter Abadi since 2015, very supportive, chairs the Labor Committee, very well regarded in Albany, and has been a good friend of retirees in general. Senator Gennardes came on board last year to do what's known as a same as bill. Under New York law and in a lot of states, you have to have a mirror image bill on both sides of the House in order for it to pass. In New York, you need to have it in the Assembly and in the Senate. New York has an Assembly instead of a House, but in any event, Senator Gennardes has stepped up, and we have a same as bill, and these bills are now both pending in the Senate Insurance Committee and in the Assembly Insurance Committee. And to the extent New Yorkers are on this call and want to write to those individuals and to the insurance committees, I would be happy to help you and steer you in the right direction. I've also, in this case, reached out to the Department of Financial Services. They know about the bills and they know about the issue. And I've reached out to the head of the head of the Senate and the head of the Assembly. So a number of people in New York are familiar with this. It has a number of co-sponsors, and all we need to do is push it at the Insurance Committee. Unfortunately, pushing things at the Insurance Committee level in New York State is not an easy thing. Next slide, please. John had asked me yesterday when we were talking generally about the presentation today, he'd asked me about, the impact of the insurance lobby. And it's something that I deal with, on a regular basis. The NCOIL draft resolution that I prepared, I drafted with a lawyer from the ACLI, which is the American Council of Life Insurers. So they're fully aware of this issue, but they're not really promoting laws to prevent de-risking. But I think where we need to do a better job, or where I need to do a better job of defining what we're looking for, is we don't want to prevent de-risking. We just want it done right. And we want transparency and accountability. And they seem to take the view that retirees don't need it, and that the insurance companies are taking care of themselves, and that even during the financial crisis, insurance companies did great. Well, there's a lot of reasons for that, but I don't think that that's really the way we want to look at it. The issue is, what do we need to be concerned about going forward? And going forward, we don't have to say insurance companies are better or worse than banks. We have to say, do we have too much risk in the hands of too few companies? And do we need more transparency and accountability? And the way you get that is by more disclosures. So I'm going to continue to fight with the ACLI or work with them if they're willing. And in New York, there's an organization that's kind of a state level version of the ACLI, which is the Life Insurance Council of New York, or Lyconi. That's the voice of the life insurance industry in New York. They have a number of members, 52 domestic members, 21 non-domestic, non-domestic meaning outside of the state of New York. So they're a very powerful and well-funded organization, and they know all about these issues, and they know all about the insurance committee and why the bills in New York are not moving past the insurance committees. Next slide, please. Okay, I'm not going to go through every bill that we've introduced over the years, but I will tell you about an issue that came up in Pennsylvania just to highlight it. We had a House Bill 1283 introduced in 2019, carried over into 2020. Unfortunately, it was never voted on. They did something unusual in Pennsylvania. They put the bill on the table, then they take the bill off the table. Then they put the bill on the table and they take the bill off the table, but they never voted on it. I understand that there was some significant opposition from certain union leaders. We tried to address that because, frankly, unions should really be watching pension de-risking very carefully. We tried to write it in a way that would be 100% union friendly, because we are 100% union friendly and we share the same issues, and that's protecting earned benefits for retirees, be they union or non-union. And the main issue is, once a pension is de-risked, it doesn't matter anymore. We're only talking about situations involving a defined benefit plan sponsor transferring to an annuity company. So I'd like to see union membership more on board, and I hope that'll change over time. But they did oppose this bill for reasons that I didn't fully understand. And I just wanted to let you guys know that. The main issue for unions is to address it in collective bargaining. If you don't address pension risk transfer in collective bargaining, that's where you lose the right if you're a union leader. But we're looking for a new sponsor in Pennsylvania right now. Next slide, please. So we have a number of potential state initiatives. I had developed these based on retiree contacts that I had, and these evolve all the time. In addition to, Connecticut, New York, and Pennsylvania, we have worked on something in Rhode Island that we're going to revisit. We've tried to get some things introduced in New Jersey. Maryland and Delaware are also on the list. Massachusetts, we had a bill introduced, but it was set for a study. I don't know the result about the study, but we're going to try and reintroduce another bill in Massachusetts. And I'm looking for, obviously, a retiree rep. California is a very, very large state and a somewhat progressive state on this issue. So we're looking for California retiree reps to do that as well. My primary contacts were with the Beltel retirees and with the DuPont retirees. And we had some folks in California, but not a big block, but that's changing and evolving over time. I also had some interest in Michigan, as I've been in touch with some of the Chrysler retirees who also had their annuity transferred in part to Athene. So a lot of these issues have come up for a lot of organizations. So because of that, next slide, please. Because of that, I've come up with some really key issues, I think, that are important to be addressed at the state level And this is really, if there's a takeaway from this presentations that you guys all have, it's this list here. And it's very important because these issues apply almost across the board. Number one, if your pension was protected under ERISA from creditor claims, it should be protected under state law. There's no rational reason you should have that right taken away from you without a full and fair opportunity to be heard. That's a really basic notion that most people agree with when it's put to them, but somehow defined benefit plan sponsors have gotten away with taking away that uniform protection from retirees, and I think it's wrong. The good news is insurance companies don't really fight that because all they want to know is who to pay. So as long as they don't have to pay twice, they're somewhat indifferent to this particular provision. And I don't find it being fought very often by the insurance companies. That's not to say some other group wouldn't object, but insurance lobby hasn't fought me too much on creditor protections. Subsequent transfers, again, we talked about the issue, but it's a key thing to bear in mind. Insurance companies transfer risk all the time. They get out of business. If you follow what's been going on recently, there's been more M&A in the insurance industry in the past couple of months than we've seen in the past couple of years. And the expectation is that's going to continue. Number three is probably one of the hardest issues to deal with. I am a big advocate for more disclosure. Insurance lobbyists don't necessarily like requiring disclosures. They fight disclosures when they can. I don't think they have a rational basis for fighting disclosures, but they do. And that's where we need retirees to be very vocal and very active, because retirees have a right to know what's happening with their pension. And requiring a simple annual disclosure about how separate accounts are performing relative to expectations is not a big ask, and it would provide retirees with a lot of peace of mind. And you don't want to find out when it's too late to do anything about it. And I found out in my experience, more and more retirees are using their pensions to pay for their grandkids or their kids. And so this money is very much important to retirees. And it's something that we need to look at all the time so we don't find out when it's too late to do something about it. Guarantee association coverage issues. It's somewhat of a tough issue with the insurance industry. They claim it's a great safety net. I've mapped out what the issues are. The concern is always, it's not so much comparing the PBGC to the guarantee associations. The real issue is, let's not have a big company like Prudential or Athene fail. That would be a disaster. So while we are fighting for transparency and accountability, we don't want to have a big insurance company failure, but we do think that guarantee association coverage issues should take front and center. I believe that state law should be amended so that any insurance company that takes on a pension obligation should be held to a uniform fiduciary standard. I don't think an insurance company should be able to argue that it's not a fiduciary for a retiree. That's my view. I do get friction on it, but I don't think it's a big ask. Under ERISA, a plan sponsors a fiduciary. They should be under state law as well. Next slide, please. Well, because we had so much success at the state level when we got the right support, and because Protect Seniors in part went out of business, and because we thought this is something worth doing, we created a company called Retirees for Justice. It's a 501c4 lobbying organization that exists solely to protect earned benefits for retirees. It's very, very, very new. I've shared information about it with John as I was creating it because I really wanted retiree feedback. I've also gotten significant feedback from the Association of Belltel Retirees. We have decided that membership is free to all retirees. So anybody who wants to join will be able to join for free. There will be fundraising campaigns tied to specific legislative activity, but the goal is to get as many people to join as possible. There'll be all sorts of great content. We believe there's force in numbers, and we're going to work as hard as we possibly can to protect earned benefits involving state legislation and also amendments to ERISA, because I think that's something that's really, really, really important because of all the changes that have occurred to ERISA over the years. Next slide, please. And that's it. So I've completed kind of the overview of pension de-risking and why it matters to retirees. And now I think what I'd like to do is just open the floor to questions. So if Connie or Julie want to read me the questions, I'm happy to take them.
And Julie, I also need you to turn back the host back to me so we don't lose the meeting at the end.
I will do that.
right.
Okay, Eddie, I think we answered most of the questions as we went along. There were a couple, and I think these may have been touched on, but I'll read them just in case. There was a question about whether or not supplemental plans are guaranteed by the PVGC.
Any plan that's covered under ERISA is covered by the PVGC.
Okay,
So
and then there,
if you're getting the statements, if you're getting an annual funding notice under ERISA, that'll tell you that it's covered. As you know, I have to see the supplemental plan itself, but if it's covered under ERISA, then you get PVGC coverage.
and then there was another question about how would a maximum benefit change at early retirement?
Well, a maximum benefit change at early retirement would be governed under ERISA. So there would be no change in the maximum benefit. But what happens when a de-risking transfer takes place, whatever benefits you have to be fixed and determined. You'll never get a cost of living increase once it's been de-risked. The benefits will be fixed and determined. That's what the group annuity contracts all say.
That's all the questions I had so far. Alex Brown had asked about Massachusetts legislation. I know you touched on that. There is a GE retiree group there.
Yeah, no, and we would love to submit a new bill in Massachusetts. We did have some support for it in the past, so I'd love to reintroduce one. I have it already drafted. So, you know, Retirees for Justice will be introducing something in Massachusetts, and if anybody, Mr. Brown or anybody else wants to support that effort, just let me know, and we're off to the races.
Okay. I want to, I'm not going to unmute everybody in case there's background noise, but if anybody else has a question, you could raise your hand. Hopefully we'll see it. Somebody will see it, Connie, Julie, or myself, if there's any other further questions. Kevin?
Yeah, is it possible to get slides of the presentation? And I'd also want to work on that Massachusetts plan.
Okay.
If you
Well, if you're willing to work on the Massachusetts plan, of course you can have the presentation.
yeah,
The presentation will be made available to everybody.
yeah.
You can reach out to me or to John or Connie if you need it.
No. I spoke at the very first Belltel Retirees Convention in Boston.
Oh, that's
I dealt with
fantastic.
them. Bill Jones was a good friend of mine.
Bill is a wonderful, you know, Bill was with me when I did the best practices resolution at NCOIL.
Okay.
Bill was with me, and I think the world of him. Unfortunately, he is pretty much retired completely, and he's no longer active in the association.
I heard.
Wonderful guy, and I learned a lot from him.
We had Representative John Tierney from Massachusetts from my district was and Bill and I put that together and put that I forget the bill number off the top of my head, but Bill was very appreciative of that.
Okay,
No,
we got some other questions, folks, so.
Okay, but we will definitely keep in touch, and I'll be delighted to work with you on Massachusetts, and the Bill Jones connection goes a long way with me.
Yep.
Julie or Connie, did you pick up the question about the carve out of a theme? What the question was? I saw it briefly up on the screen. Julie or Connie, did you see it?
Yeah, can you hear me? It says, why did GE only carve out a portion benefit of its obligation to ATH?
Yes, that's a great question. So the reason is it costs money to do one of these transactions. So Athene wants to get paid. So when a company transfers obligations to an insurance company, it has to pay a premium or it transfers the assets that are in the trust fund. They didn't have enough because the plan wasn't fully funded to transfer the whole plan. So they selected a chunk and they offloaded that chunk. Does that make sense to everybody?
Yes.
John Melody has her hand up.
Yeah, a question I had was on the annuity, the state guarantee, like for Indiana is 250,000. If you have additional annuities, is that per annuity that you're guaranteed the 250,000?
If it's with a different company, you would have a different additional coverage, but coverage
Okay,
is
so-
per individual, per lifetime, per insurance company.
So it's advantageous if when you are possibly going to get that annuity, if it could go to more than one company,
Exactly.
that should be an option that we should be looking at also, depending on what we have that would go to the annuity.
Right, both because you're diversifying risk and because you would have more guarantee association coverage. That's correct.
Correct. Okay, thank you.
You're welcome. It's a good question.
I do think, I'm sorry, if you don't mind,
No.
there's a lot of unclaimed pension too that falls in that category. You know, I have a friend that gets $63 a month. Well, it's being paid out, so they turned it down at that point, but that's something that should be looked at again also, because now they can do that.
I'm sorry, I missed the first part. Can you repeat your question
Okay.
or
I
comment?
have a friend that receives $63 a month. And some pensions are even unclaimed, but it used to be, they wouldn't go ahead and give her a lump sum for the $63 because that's not her main income, hasn't been since she was vested. But now that's something that they can look at, even though they're receiving pension, they're now eligible to be able to pay out lump sum.
Okay, so lump sums, you know, like I said, lump sums were kind of banned for a while because
Mhm.
for protectionist reasons, you now can do them again.
Yes,
And very often, the folks that are receiving relatively modest benefits are the ones that are offered lump sums because the cost of administering smaller checks is high relative to the check amount, right?
and their pension benefits premium that they're paying for them also.
Correct, 100%. And they still have to pay the same amount because the fixed premium to the PBGC is the same,
That's correct.
right?
Which reminds me, if there's anybody that's been affected by the Athene transfer, we would like to know that. You could email me or PM me on Facebook or whatever way you want to do it, call me. My number is always on Facebook, always on our formal website. You can call Ed, you got his number. We'd like to know those people. We've gotten some that have talked to us, but we'd like to get more if we could get them.
Eddie, there was a question from Brian. Do you know what part of de-risking a union would impose?
Well, what I understand, and I can't speak for the unions, but what I understood came up in Pennsylvania was they are opposed to de-risking across the board. And that's why they opposed the legislation, because they thought that the legislation was going to encourage de-risking. So there's no specific aspect of de-risking that I heard, you know, from the unions being objectionable. It was just they didn't oppose de-risking generally. And I think what really was going on is they want to make sure that it's something that they retain for them to deal with in collective bargaining, which they should. But that was the only issue that I really got color on.
Remember that these, as Kevin had already asked, but this whole presentation will be on our formal website with any materials that were associated with it, like the agenda. I saw when Eddie would finish an explanation on the different term or whatever, was that clear? And I saw people smile or shake their head a little bit. Listen, none of us understands this stuff the way Eddie understands it. Believe me, when I tell you, you know, that's why we use experts and lawyers for this kind of stuff. They have a better idea about the legalities of it all, you know? So don't be afraid to reach out to Eddie for clarification on anything on this, or any of us, if we could help you. The board has been through this presentation a couple times, and we have a little clearer idea, but certainly we'll try to answer any questions or clarifications you need. So I want to make that point. The other thing I want to say to you is kind of a disclaimer. Listen, we made our best effort to give you accurate information here. We don't have any crystal ball about GE or what GE is going to do, or any projections about future plans by GE concerning the pension plan. We're giving the information that we know, and we're giving you our concern. So I know there was supposed to be news media on this Zoom conference. And we would ask anybody that's from any kind of news media, if you need clarification, please don't quote things or misquote things from this presentation, and clarify those issues with Eddie or myself before, if it goes to media, print or otherwise. We would like that stuff clarified through us, please, on any information that was shared. The idea in the end, on one of the last slides, is we need to be proactive, not reactive. You know, we can't wait until the damage is done and then react and try to change it. We need to be proactive, as I said, legislation, lobbyists, raising our voice to GE, raising our concerns to GE, which we, any national retiree reps that are on this conference call know we do it in the fall, we do it in the spring, we do it at the share owners meeting, and we'll continue to do that. That's why we're having this webinar, to raise that awareness and give you this information. So we will definitely be proactive as a group, and hopefully all of you that are attending here will join us in being proactive on these concerns about pension de-risking. Eddie, do you want to add anything to the disclaimer? Or?
No, look, I think I'm pretty confident in the things that I kind of relayed to you today, so I don't have a problem with folks printing it. I obviously think to some extent, the things we discuss are concerns that we have, and some of the things that I identified are things that I need to know more about. But, you know, the real issue is there's no question in my mind that when a defined benefit plan sponsor gets rid of retirees through an annuity purchase, right? There are issues that are raised that have to be addressed. And a lot of the things that I've identified is for the purpose of shedding light on the practice and for us all collectively to pursue transparency and accountability with respect to retiree earned benefits. And to the extent it's taken with that, you know, viewpoint in mind, it's all really, we're not trying to prevent de-risking. We just want to encourage it to be done in the way that's in the best interest of the retirees.
Okay.
I think there was another question before. I saw a hand up. I don't know if you guys have caught that. Connie's muted.
Oh, I gotta unmute you, Connie, or what? What do I gotta do here? Honestly,
Eddie, this is Bill Muller. Are there any categories of GE retirees that would not be subject to de-risking that are protected under ERISA?
No, if you're protected under ERISA, you know, you could be subject to de-risking as part of a, if there is a private, sometimes executives create plans that are not ERISA protected plans. And in that case, you know, they still could be subject to de-risking. It just would be a different form. It wouldn't involve ERISA.
And being vested or not, that doesn't come into consideration.
Well, so when the plan is de-risked and through the purchase of an annuity contract, the benefits have to be fixed and determined. So if they transfer fixed and determined benefits, they probably would have frozen the plan, so there wouldn't be any future vesting. If the plan stays in effect and there's no freeze in place, you could continue to vest into, or you could continue to either age into benefits or vest in benefits.
If you are vested.
If you're already vested, then they won't change. They can't be taken away under ERISA. The annuity would have to provide the vested benefit in the payout schedule.
Thank you. That clarifies it.
Okay, good.
when Eddie was referring to the GE statement that you get once a year, this is the one you get. This is the kind of thing you will not get from Athene or
Right.
offshore or anything like that. It gives you all the financials and what's it called? Annual funding notice. All right.
Right.
This is the type of thing. So you should all have this. You should get this every year.
And I would encourage you to keep those and also look not only at the annual funding notice, but the supplement. The supplement shows the impact of using unadjusted rates.
Okay. Any other questions? Julie, your picture's up there, always smiling. Okay, is everybody happy? Well, we're really glad you all joined us, and hopefully this was a learning event and you took a lot away from this event, and it will be published on our formal website. I know I had to review it a couple of times. I'm sure all of you will. And Eddie's available, we're available. If you have any more questions or clarification you need in the future, and please feel free to share this once it's published with retiree groups or chapters, whatever. Like Kevin said, and I know Schenectady also said, can you send this stuff and we'll show it in our retiree chapter meeting, you know, so that's good stuff. That's networking and getting the message out there to other groups, okay? All right. Eddie, you all set?
All set. Thank you, guys. It was an honor presenting to you, and I wish you all the best.
All right.
Thank you very
Eddie and
much.
Julie.
Thank you.
You're welcome.
Thank you.
Thanks, guys.
All right, I'm gonna end this, folks, so it's
Take
gonna go to
care.
recording. All right, Ed, we'll be talking.
Thanks, John. Take
All
care.
right.
Bye.
Now, let's see here. End meeting.